Yeah, Matt, this thing, even as equities were rallying yesterday, despite the grim economic picture, there is a growing sense of hedges, of investors skeptical about the rally. And you can see that playing out in the short interest that is growing. Now, some of that might have to do with exactly what is leading the gains. The breadth does not look great. It's mostly big tech, Amazon touching new highs. And with the leadership so thin, the internals don't look strong. We see small caps lagging. So for that reason, we're seeing the short interest being taken out on vehicles that will essentially hedge the entirety of the market. So a perfect example of this is SPY, the S&P 500 iShares ETF, State Street rather. More than a quarter of their total shares floated are shorted. So that's a very high proportion. It also lines up with what we've seen in the latest CFTC data, where we see the biggest net short from large speculators since February of 2019. Now, interestingly enough, credit, which also has a very high correlation with equities, has taken off as well, and shorts are growing there as well. HYG, again, one of the largest ETFs tracking junk bonds, is nearing the highest short interest on record. That's as we saw a massive rally. And even though we have this Fed backstop, investors are still shorting it, saying, look, the Fed has helped with liquidity risk, but the insolvency risk is not gone. Now, noticeably absent, though, from the shorts is big tech. I mean, if you're shorting big tech right now, you're likely to get burnt. The NASDAQ 100 ETF has seen a short interest fall. Amazon short interest still at just above 1%, though that is higher than its average. Still, investors hesitant to make any big bets against tech, considering that's what's been leading the rebounds, Matt.